Good day, fellow investors. The JPM quarterly guide to markets is out, and let's see what they have for us for this quarter. I'm going to discuss the market's craziness, the economy getting weaker, the government, inflation, oil, how that all works together, investing into global markets and investing today. Let's start. If you enjoyed this, smash that like button. If we look at the market craziness, well, that's something crazy. This is a clear sign, this movement here, 61% over the last 2 years. This is a sign that fundamentals have no matter. It's only about momentum. Down, up, straight up. Here maybe we still talked a little bit about fundamentals, but this now is complete and utter craziness. Why? Because valuations simply don't matter. Even if we take this S&P valuation measures, the forward price earnings ratio that takes into account the expected estimated future earnings from 1994, thus all exuberant years with the dot-com bubble, we are at the expensive side of things. If I go further back in history, this is the chart that I have just shown you, and you can see that the average P ratio is closer to 25, historically to 15. So we are in a market that's exuberant even by current market standards. So now we are expensive and hugely even more expensive on the historical side. But there is always something that justifies the market, and in this case, those are, as always, earnings growth projections. 9% for this year, 15% for next year, and 12% for 26. Thus, earnings are going to grow, therefore valuations will come down or stock prices will go up. 241 is the projected earnings for 24 dollars per S&P 500 share. If we look at it from that perspective, the reality with the latest data we have, March 24 was 192 and going down. This means that it should grow 25% from the March quarter to the end of 24. 25% growth is what analysts have been drinking lately. And then if we immediately go to current results, real results from Earnings Insight, where you have the data somehow manipulated, but usually okay. And industry analysts project 9% increase in the S&P 500 over the next 12 months. So they always project stocks to go up 10% per year. That's their job, just to repeat that as a parrot. But if we look at their past projections, the S&P 500 was projected to be around 5,000 points, not 5,700. So even they can make mistakes in their exuberance. But this is perhaps the most important part. Now, we have the earnings estimates that are extremely exuberant, and then we have reality. When reality comes in, real earnings growth year over year for the quarter was not 20, was not 15, was not 10, was 4.6% compared to the estimate growth rate of 7.8%. So when real earnings come in, those are always lower, and the rest is just craziness, market craziness. Again, from 1997, now value looks cheap, but not extremely cheap, because there isn't no more value, let's say, in the US market, however you look at that. Further, index concentration, we are now at 36%, the top 10 stocks of the S&P 500. The remaining 494 have 64.2%. And if we look at investing in the top stocks, this is 1999, Microsoft, okay, General Electric, Intel, Walmart, Exxon, Coca-Cola, okay, companies. Some are not there anymore, but okay, it doesn't matter. What matters is the following. If you look at this list of companies And if you look at this list of companies, this company wasn't there, this company wasn't there, this company wasn't there, this company wasn't there, this company wasn't founded, this company wasn't founded, etc., etc. So you never know, but in the next 20-25 years, all the great businesses, the big companies from now, might be replaced by somebody else, especially with all the AI technologies and capabilities that we will have in the future. Thus, to me, this risk-taking is completely crazy. But what explains it all? Just look at this. With what you can say a minor blip here, what was it, 2022, we have 29%, 16, 27, 24, 21, and it is somehow expected now that the market grows not 10, but 20% per year. So just ship your money into the S&P 500 and it will grow 10, 15, 20% per year. That's how easy it is. To me, that's completely crazy, but we live in such a world and I am not the majority, therefore I can just comment as a value investor and look at things from a risk and reward perspective. The reward is very small, the risk is crazy, you make your call. Going further to the economy, we have again the economy getting a little bit weaker. If we look at the expected growth of 2%, and then if I look at the trend, and if I look at the economy over the last 15 years, this is the US economy, it just barely somewhere touches on the trend. So actually, in reality, it is constantly below the trend. If I look at the recession determinates, we are not in green, we are, let's say, orange, so nothing special there. And if we look at some factors, service pay ratios are going up with higher interest rates, of course. Defaults are going up, so we are there. I'm not predicting a recession, but you never know. And it's not that much about the recession. The long-term growth rate is key, and what is building that long-term growth rate? 1%, 0.5%, 2% real growth. That's a huge difference in expectations, in debt services, in payments, in your retirement. 1-2% per year compounds a lot over 20 years. That is what matters, not whether there will be a recession in the next 6 months or 12 months or not. Because if we look at government, inflation, oil, rates, interest rates, we all know that the government needs to borrow a lot of money just to keep things stable, and this deficit number, every time I open the JPM guide to markets, this deficit number is larger, bigger and bigger. The US government needs to borrow more and more to keep spending high, just to keep the economy churning and everything going. And here you have the expectations of real GDP growth, always around 2%, but that 2% doesn't even exist without these deficits. Then it's 0 or minus 2%. So it is just expected that deficits will keep accumulating and debt to GDP will keep exploding, because that's the only way to keep the current levels at least looking like things are good. Now, if you have a lot of debt, you need to have inflation. But how much inflation? And now inflation is down. Why? We'll see later. But inflation, let's say, okay, we can now start lowering interest rates. And inflation is down because energy prices have subdued. You see the green here. Now it's on the negative, and core goods on a little bit less spending is also on the negative. The rest, shelter, auto insurance, dining, recreation and other services are still holding their part, and food at home is just small. But we are still, if I look at this, from an average year to year, we are still at 3.5%, not at 2% or below that we need to lower interest rates. But okay, with energy down, oil down, we'll see now if there will be any things happening with the crisis in the Middle East. But the likelihood is that oil will hit 50 before 100. 100 would again spiral inflation, 50 is a little bit better, it's not far from where it was, that's the balance there. But speaking of interest rates, now we are at 5%. We were at 5.5 for a while, which is clearly unsustainable, and interest rates have to go lower, and everyone expects those to reach 3% next year, likely. The balance sheet of the Fed has been lowered a little bit, but that's it. The maximum has been reached. More Fed lowering of balance sheet or interest rates staying higher, big recession. That's it. We are now at the turning point and we need to do that. But still, if you look at interest rates and inflation, those owning the 10-year US Treasury bill are barely making a profit, which is crazy and ridiculous. But the governments, central banks try to keep this as you are making some money, but you are not, and the global debt levels, the bond market is $140 trillion. And let me show you something to show how those things move and why we might be at a turning point. So we have borrowing to keep things stable, okay, higher rates, inflation is down, but interest rates are at 5%, and that is why inflation is down. Okay. Now, we need to lower interest rates because there are huge debts everywhere, and with huge debts everywhere, we have to lower interest rates. If we lower interest rates, what happens? Inflation goes up. And this is exactly why we might be at a turning point. If now interest rates go down, but inflation starts picking up, then the Fed will not be able to lower rates anymore, and the huge debts, the borrowings, will lead to a terrible situation. And that is why this is not a sustainable financial environment. I hope it doesn't turn. I hope the Fed can manage it, but for how long, that's the only question. Government debts across the developed world are just growing, growing, and growing. Interest rates will go up and down, that's a given. Thus, the fundamentals are clear. Everyone can see it. The question is just when. When will it stop functioning? And you can see here that this is the clear trend. There is nothing one can argue against it. Now, we have seen the fundamentals, and now we have to come to investing. Actually, the crazy fundamentals also explain the crazy market. What's best to own then? Properties, land, assets, businesses that will protect you from inflation in the future. Therefore, in a part, even the crazy market can be justified in a sense. It's still risky, but you can understand the justification. It's better to own Apple, Amazon than anything else. Then 10-year treasuries is 0.5%. That's nothing in real terms. Again, better owned businesses that give you real returns can increase prices. So it holds, but is still risky, too risky from a value investment perspective. And then if we look at the share of global market capitalization, 64% US, 11% Europe, that's 75%. What's that? 1 billion people. Then we have 10% emerging markets. What's that? 5 billion people. Now I can buy 10% of the market and I get 60% of the population. That's something staggering. If we look at valuations, 2 standard deviation cheaper, never so cheap compared to the US. The dividend yield more than double the US. Thus, if you look at global earnings, global valuations, extremely cheap from that perspective. And then if you look at earnings, China is the purple one, not far from the US. And the US actually earnings growth has been manipulated with money printing. So, okay. Yes, again, if interest rates go down, then again, stocks are the only answer, but I prefer to own better, cheaper, that will give me better returns in the future. How to invest? How does this all fit the process of value investing? Well, I just told you that that's pretty easy because when it comes to investing, you have to ask what drives your long-term investment returns. What are the drivers? Valuations or fundamentals? And that's a decision you make once in your lifetime and you follow for your whole life. And I can tell you, at the end of your investing cycle, the difference will be huge. Because let's look at this. The current Shiller P ratio, 10-year average earnings of the S&P 500 is 36. The average is less than half of that. And there have been also lower levels at 7. But okay, let's take half, let's say 18, 17, which is half of the current. If I then look at the S&P 500, we are now at these levels. If I put an average historical price-earnings ratio to this current S&P 500 level, we are, of course, 50% down. And this was not so far ago. 50% down because what drives long-term investing returns? Earnings, dividends, and growth. Yes, all good. But the key is the price you pay. The price you pay for whatever you are buying. That's the key. And in that environment, when it comes to investing, you need to buy great things at a good price because that's the key driver. You get more earnings, you get more dividends, you get the growth for a better price. That's exactly also what I do on my research platform. Check it in the link in the description below. We are now, started it in 2018, made mistakes, but we are now there in performance with the S&P 500. But the S&P 500 has had a stellar performance. I would call it a miraculous performance over the last 6 years, 6.5 years. We just keep compounding and churning on the value investments, the unliked things, and we just keep on doing the returns. I think we'll keep on doing those returns for the next 7 years. I don't know about the S&P 500. That's it from me. Thanks for watching. Keep value investing, and I'll see you in the next video.